Most Canadians treat their RRSP tax refund like a surprise bonus to fund a vacation or a new gadget, effectively throwing away a massive component of their retirement compound interest. When you contribute to your registered retirement savings plan, you are lowering your taxable income, which often results in a significant cash injection from the CRA. If you simply spend that money instead of putting it back to work, you are essentially cannibalizing your future self's wealth to pay for today's lifestyle. To stop this leak, decide on your contribution amount based on your target tax bracket rather than just what you can afford to lose today. To understand why this matters, you have to look at the math of reinvestment. If you receive a $2,000 refund and immediately move it back into your RRSP or a TFSA, that money starts compounding immediately alongside your original principal. Over a 20-year horizon, that single reinvested refund could grow into several $1,000s of additional retirement nest egg. Don't let the money sit in a zero-interest checking account. Set up an automatic transfer for the day your tax refund arrives to ensure it is immediately reinvested. One of the most common errors is contributing to an RRSP when you are already in a lower tax bracket, which limits the immediate tax deduction benefit. If your income is low, you might be better off prioritizing your tax-free savings account to keep your money accessible without future tax penalties. Compare your current marginal tax rate against your expected tax rate in retirement to ensure the deduction actually provides a net gain. Always run a quick calculation of your projected annual income before making large lump sum RRSP contributions. Current market conditions require a more disciplined approach to where your RRSP funds are actually parked. With the Bank of Canada policy rate at 2.25% and the 10-year yield sitting at 3.69%, the landscape for fixed income investments has shifted significantly. You need to ensure your RRSP isn't just sitting in a low-yield cash fund when higher-yielding opportunities exist in the bond or equity markets. Review your asset allocation quarterly to ensure your RRSP investments are aligned with current yields and your specific time horizon. The ultimate goal of the RRSP is not the refund, but the tax-deferred growth, yet many people fail to plan for the inevitable tax hit during withdrawal. Every dollar you take out of an RRSP is taxed as regular income, meaning if you wait until you are in a high-income year to retire, you could lose nearly half of your savings to the CRA. Successful RRSP users balance their contributions now with a plan to minimize their income during their retirement years. Consult a tax professional to create a multi-year withdrawal strategy that avoids pushing you into a higher tax bracket later. To truly turn your RRSP into a wealth engine, you must view the refund as a tool for aggressive reinvestment rather than a windfall. When you pair the tax deduction with the tax-deferred growth, the mathematical advantage over a standard non-registered account is massive over several decades. The most successful investors use the RRSP loop, where the refund is immediately used to buy more assets, creating a cycle of continuous growth. Before the end of the calendar year, perform a full audit of your available contribution room to maximize every available dollar of tax savings. The single biggest takeaway is this: your RRSP refund is not free money for spending. It is a delayed tax payment that belongs in your investment portfolio. If you stop treating the refund as a gift and start treating it as a high-velocity reinvestment tool, you drastically shorten your path to financial independence. To stay ahead of shifting Canadian tax laws and interest rate volatility, subscribe to the Loonie Report for deep dives into your wallet's survival. Subscribe to keep your financial literacy growing.